Good morning, students. Now we will be doing cash flow from operating activities. Second part, that is, we will be doing prior to working capital changes. Means we will be only seeing the operating activities. Cash flow from operating activities means we will be only getting the operating profit over here. Operating profit, calculation of operating profit. That only we will be noticing over here. Calculation of operating profit. Next, so how to see the operating profit? See, we have to calculate NPBT, which we have learned already, net profit before tax. And after getting net profit before tax, we have to adjust. Adjust what? Adjust the non-cash and non-operating expenses. To see the non-cash and non-operating expenses, we need to see the adjustment and entire loan and debentures, whether having interest or not, an entire loan and debentures, that we will be seeing entire loan and debentures for interest part, for interest. So we will be seeing only what then? Again, we will see all adjustments for all non-cash and non-operating expenses, and also we will see the hidden adjustment which is given in loan and debentures, because 10% debenture, 5% loan, these are called hidden adjustments. That also we will see in this part. So again, in NPBT we will be adding non-cash and non-operating expenses, and we will subtract the non-cash and non-operating incomes. Let's do the sum. Let's do the sum to understand the thing on this. So after that, we will be doing investing activities and financing activities. Then we will be getting the cash flow from the other activities, add opening cash, that we will be doing later on. Operating expenses. What are operating expenses? Because that expenses only we have to take. See, we are doing from the back. That's why we are not taking operating expenses. That we are already added, already subtracted the operating expenses, and operating incomes are already added, which are non-operating. That we need to adjust. Non-operating incomes will be subtracted and non-operating expenses will be added back. Operating expenses are expenses which is incurred to make the sales or provide service. Adjustments for non-cash and non-operating. The hint, any expense other than outstanding and prepaid will come over here, because outstanding and prepaid are our liabilities and assets that will be dealt in current assets and current liability portion after this item. After this, we will be doing that only. Items to be added, we already have understood all non-cash expense, that is depreciation, amortization, provision for bad debts, provision for any debts, provision for expenses, etc., which are shown in the statement of profit and loss debit side, but they do not result in the outflow of cash, should be added back to net profit to calculate the cash from operating profit. And for non-operating expenses such as interest on borrowing, both long-term and short-term, loss on sale of fixed asset, underwriting commissions are added, and these are non-operating activities but are shown in investing and financing activities. So why we will add depreciation? Because of non-cash expense. Amortization means depreciation of the intangible assets. That also is a non-cash. That's why we will be adding up. Loss on sale of fixed assets. It is an item of non-operating item. So we will be adding it up because already subtracted, to get net profit before tax. We have got net profit before tax. So already depreciation, amortization, loss on sale of fixed assets, interest on long term and short term, and provisions. Already these have been subtracted to get the profit before tax. So we are adding back these all in order to get operating profit. We have got net profit. Now we are reaching to operating profit. And whatever items we have already added to get the net profit, that is gain on sale of fixed assets, receipt of interest or dividend, rent received, transfer of any excess provision. So those will be subtracted in order to get operating profit, because they have already been included in the net profit. These are the reasons why we are subtracting this all. Okay. Now let's do a sum. Sums to calculate operating profit before working capital changes. The sum is given: net profit before tax is 4 lakhs, depreciation is 20,000, goodwill amortized value is 30,000, interest on debenture 40,000, interest on bank overdraft is 20,000, share issue expenses 10,000, loss on sale of investment 5,000, profit on sale of equipment 10,000, and interest and dividend received is 5,000, and loss on premium on redemption is 2,000. These are the different expenses given over here. See, in this sum already we have net profit before tax. So that means that rough calculation, that net profit after tax, from that we have to come to NPBT. That is not required. We will directly start with NPBT. See, net profit before tax, which used to have a rough work, that is not required in this sum. It's already given 4 lakhs. And all non-cash and non-operating expenses we have to add back, like depreciation, goodwill amortized, interest on debentures, interest on bank overdraft. Notice these are all given: interest on bank overdraft, interest on debenture. These are all non-cash and non-cash or non-operating. Interest, this means financial charges are nothing but non-operating. So we are just removing all those financial charges. Interest on debentures, interest on bank overdraft. Share issue expense is also non-operating, not every time. So 10,000, that is also to be added back. Loss on sale of investment to be added back. Loss on premium or redemption to be added back. Why we are adding? Because we have already subtracted in order to get net profit before tax. Now we have got net profit before tax, we have to reach higher level. That means we have to go to operating profit. Remember, gross profit, net profit. In between is operating profit. So we have to reach the operating profit. In order to reach the operating profit, we are adding back these all things. So when we have added, we got 1 lakh 27, 4 lakhs plus 1 lakh 27 is 5 lakh 27,000, and some non-operating incomes were there that we need to subtract because they are already being added to net profit before tax. Like profit on sale of equipment, we have already added, so we have to subtract that. Interest and dividend received on investment, that is already added, we are subtracting. So 15,000 we need to subtract, and operating profit before working capital changes is coming to 5 lakh 12,000. One more sum we will be doing, students. This is starting with net loss. So NPBT, it is NLBT, net loss before tax. And intangible asset written off means depreciation only. Debenture issue expense, again issue expense. Bad debts is there. Provision for doubtful debts is there. Income includes liabilities written back. This is also there. Rent received during the year. Finance cost, I told you finance cost not to be taken. Preliminary expenses not to be taken, and employee benefit expenses are given. So net loss before tax 4 lakh. It is net loss, that's why in the bracket, because it's a negative figure. And all those non-cash and non-operating expenses are added back. Intangible assets written off means depreciation. Debenture issue expense written back. Bad debts, it's a non-operating, so 2,000 added back. Preliminary expenses non-operating, so 3,000 added back. Provision for doubtful debts, I told you already, provisions non-operating 5,000 added back. And finance cost 5,000 is added back. When we are adding all these 50,000, so we are getting 3,50,000 over here as what? Still loss. Now we will be we are getting 3,50,000. Yes, the loss has reduced a bit. Non-operating income like rent received during the year and liability written back, that also we are subtracting now because they were already added. So 13,000. So operating profit before working capital changes is coming to 3 lakh 63. That means 3 lakh 50 loss minus was there and 13,000 more. Notice one thing, student, this employee benefit expense is a very much part of our operating expense. So we are not taking that. See, operating expenses include selling and distribution expense. It includes administrative expense. It includes um, administrative expenses and operating expenses, selling and distribution expenses, office expenses. So employee benefit expense being an administrative expense, we are not subtracting. It is already there. So let it be there. We are not adding it back. So 3,63,000 is an outflow for the time being. You can understand operating or operating profit before working capital changes. If there is no other information regarding operating activities, then we can say this is an outflow from operating activities. One more sum, student. Now this sum is a part of balance sheet is given to you. We have to calculate operating profit before working capital changes. See, when balance sheet is given, where we will see only reserves and surplus. And we will also see this borrowings. See, 10% debenture is given. We will also see that whether there is investment or not. Yes, there is investment. It must have an interest. We will see the adjustment to see that interest is there. The three items only we have to see from the big sum. One is reserves and surplus, one is this borrowing 10%, and one is this investment. Let's see the adjustments given. So reserves and surplus has this surplus, general reserve and security premium reserve. We have to calculate, that means NPBT. For that, SPR is not required. For security premium, for calculation of NPBT, we will start with NAT, net profit after tax, which is given over here. 30,000 in last year and 68,000 this year. So in that case, our calculation for NPBT, which is done in rough, is over here. Surplus closing minus opening, 38,000 is coming. And general reserve also we have to do closing 55,000, opening was 55,000, closing is 20,000. So 20 minus 55 minus 35,000 general reserve. So that also needs to be subtracted. So 3,000 is coming our NPBT, net profit before tax. So 3,000 we will write in our cash flow statement, NPBT 3,000. Now we will see the interest part, see the adjustment. Achha, one more adjustment is given, discount on issue of debentures 5,000. That should have been added, but it is to be adjusted through SPR, so we ignore it. It will go in, it will reduce my SPR, which will be shown in, again, financial activity. Underwriting commission 2,000, this is to be adjusted through SPR, so it is not to be shown in operating. Otherwise, we would have added back underwriting commission. Rate of interest on investment is 10% per annum. So investment. So let's see what was the investment. Investment was 1 lakh and 2 lakhs in the previous year. See, we will consider that extra 1 lakh which has been redeemed. We have redeemed it at the beginning of the year only. Beginning of which year? Let's see the calculation. So we have seen over here interest on opening balance is considering change happened in the interest. Interest is calculated on the opening balance. Interest is calculated on the opening balance, considering change happened on the closing balance sheet date. We have considered that the change has happened in the closing balance sheet date, that is 2019, the changes have taken place. 2019. So interest is calculated on 2018's balance. It's on the opening balance, 2018 on the opening balance. So see, let's see, 2018, what was the balances of investment was 2 lakhs and this borrowing was also 2 lakhs. So both will be 20,000 and 20,000 only. So 20,000, 20,000, rate of interest on investment is also 10% and rate of interest on debentures is also 10%. So it will be on 20 lakh students, on 2 lakhs. So on 2 lakhs, when we are calculating, it is also coming 20,000. So let's see the cash flow statement. NPBT we have got 3,000. Add interest on debentures because this is a payment to be done. So when we are adding the interest on debenture, it is coming to 23,000 and less interest on investment, which is an income. Therefore, it is coming down to again 3,000. And that will be considered as operating profit before working capital changes. Hope you all have understand, students. Any queries, please let me know. Anyhow, this is your homework. Once you will do this, please go through this. NPBT is given 2 lakhs for the year ended 31st 3 2019, I say, or 20, I should say rather. And adjustments are given. You have to add back the non-operating and non-cash adjustments, expenses, and subtract the incomes which are non-operating or non-cash, and we will be getting our net profit before working capital changes or operating profit before working capital changes. Thank you, students. Hope you all have understand, and please send me the work as quickly as possible. Thank you, students.